Understanding fiduciary capacity and IRS forms. Introduction to fiduciary capacity. In today's discussion, we will explore the concept of fiduciary capacity and the relevant IRS forms often filed by individuals seeking this role, including Irs Forms 20848, 8822B, 8833B, and 56F. Many people mistakenly believe that filling out these forms will grant them fiduciary responsibilities. However, it's crucial to understand what fiduciary capacity really means and whether these forms provide what people expect. Let's dive into the concept of fiduciary capacity and clarify the essential information you need to understand about these forms. What is a fiduciary? A fiduciary is an individual or entity, such as a bank or trust company, who holds and manages assets for the benefit of another party, known as the principal. The fiduciary is obligated to act in the best interest of the principal, maintaining a high degree of trust, loyalty, and good faith. In a technical trust, the fiduciary is referred to as a trustee. Other fiduciaries in non-technical trusts might include administrators, guardians, and receivers, among others. The fiduciary role is rooted in a relationship of trust, where the fiduciary is legally required to act in the best interests of another person or entity. For example, a trustee manages a trust and holds the legal title to property for the benefit of the beneficiaries. The fiduciary role in banking. In banking, particularly for national banks, the controller of the currency defines fiduciary as a bank or financial institution that acts on behalf of another party, primarily for the benefit of the principal. This includes roles such as trustee, executor, administrator, guardian of estates, assigner, receiver, committee of estates. These institutions, under a special permit from the controller of the currency, may perform fiduciary duties, subject to regulations and laws that govern their operations. Fiduciary responsibility and financial management. Fiduciaries are not only responsible for the custody and safekeeping of assets, but also for ensuring the efficient and effective use of those assets. This responsibility extends to protecting against economic risks like inflation and deflation, technological changes, and social or environmental impacts. For businesses, fiduciary duties include making sure resources are used in a way that aligns with the interests of owners or stakeholders. Financial reports, such as balance sheets and income statements, are essential tools for evaluating the performance of fiduciaries in managing the enterprise's resources. Fiduciary funds in government and accounting. Fiduciary funds refer to assets that are held by an entity in trust for others. This includes expendable trust funds, funds where the principal can be spent. Non-expendable trust funds, funds where the principal must be preserved. Pension trust funds, funds held for employee pensions. The fiduciary responsibility here is to operate the funds according to the agreement made with the contributor of the funds, also known as the principal or corpus. The fiduciary capacity and agreements. A fiduciary relationship generally refers to any relationship where one party is entrusted with managing assets for another party's benefit. This includes roles like attorney and client, broker and principal, corporate director and shareholder, agent and principal. Fiduciary roles are often legally bound by contracts, which means any misunderstanding or misperformance could lead to severe consequences, including failure to access or manage funds properly. Misunderstanding the fiduciary role. It's important to recognize that when people fill out forms such as Irs Forms 20848, 8822B, 8833B, and 56F, they often misunderstand what fiduciary capacity means. Simply filling out these forms does not automatically grant fiduciary duties or rights. Fiduciary responsibilities come with legal agreements, and individuals must adhere to the terms of those agreements. If you don't fully understand what your agreement entails or you fail to comply with its terms, there is no payment or release of funds. The process is not about shortcuts or simple forms but about fulfilling your contractual obligations. Fiduciary currency and credit. Fiduciary currency refers to money that is not backed by physical commodities, like gold or silver, but instead by the trust and credit of the issuing bank or government. In the S. All currency is considered fiduciary currency because it is redeemable within the U.S. monetary system. The importance of understanding your agreements. A major issue arises when individuals enter into fiduciary agreements without fully understanding their implications. Misinterpreting the terms or failing to comply with the specified responsibilities can lead to complications, including the inability to access or manage funds. It's essential to read and understand the terms of your agreement before taking on any fiduciary role. This includes understanding how to interpret ambiguous terms and making sure you are aware of all the obligations involved. Conclusion. In summary, fiduciary capacity is a serious legal responsibility that involves acting in the best interest of another party. Simply filling out forms does not grant fiduciary rights or responsibilities. Legal agreements define those duties. Understanding the agreements and adhering to their terms is essential to effectively managing assets or handling funds in a fiduciary capacity. If you want to learn how to properly read and understand agreements, consider joining a training program that will help you become accountable for your contractual obligations. Avoid placing yourself in a position you don't fully understand, especially when it comes to fiduciary responsibilities. Remember, knowledge is power, and understanding your role and agreements is key to protecting your interests and managing assets responsibly.